Hi everyone, my name's Ben West. I'm Chief Strategy Officer at Pragma, and today I'll be sitting down with Mark Viviano, Managing Partner and Head of Public Equities at Kimmeridge. Mark, great to see you. It's been a busy year. How are you?
Good. It's great to see you, Ben, and congratulations on the launch of Pragma. Very exciting stuff.
Yeah, well, thanks for being involved in the journey so far, and look forward to a good conversation today. Obviously, we first spoke back in 2020, I think it was now, 4 years ago, when you had just joined Kimmeridge from Wellington. At the time, you said that the E&P sector had become uninvestable. And your thesis was very much set out around the reformation of the E&P sector. How has the E&P sector improved and evolved over the past 4 years? And has it, in your opinion, become investable again?
Yeah, no, it's a great question. I mean, I think the E&P sector has come a long way in the last 4 years. Capital discipline has generally held at higher commodity prices. Companies have been willing to prioritize the return of capital versus production growth. The industry has been more resilient, I think, than anybody would have expected 5 years ago when you look at the record level of free cash flow that's been generated. I still think there's work to be done. I still think there's a lot of pro-cyclical behavior in the industry. We could look back at 2022 when we had $100 oil, $6 gas. There were a lot of acquisitions that were done at that period of time that necessitated higher commodity prices. And I think when we look back, the timing of those wasn't ideal. So, people always ask me, what's your grade for the industry? And I'd say it's definitely well above passing, made a lot of progress, but still work to be done.
Nice. No, that makes sense. And I think we'll delve into those in a little more detail. But obviously at the moment, a lot of conversation, a lot of attention, I think, is on the incoming administration.
Yeah.
Obviously a bit of a drill baby drill mentality which has come forward. How could the incoming administration's focus on increasing fossil fuel production and regulatory rollbacks reshape global markets and capital allocation strategies?
Yeah, it's a critical question that investors are debating, allocators are debating. I've never been a big believer in the drill baby drill mantra, just because I think capital allocation is really a bottom-up decision at the company level. Public company shareholders have remained convicted that they want to see return of capital over production growth. I don't expect that to change even in a new administration. Clearly, where it's going to have the biggest impact is on the infrastructure side. And I think when you look at the ability to increase LNG exports and reverse the Biden LNG pause, that probably has the most meaningful impact when you think about the global supply of natural gas. And I do think from a decarbonization perspective, the biggest impact that we can have is sending clean, zero emission LNG to the rest of the world, replacing coal, unleashing US LNG. I think that's going to be a day one priority for the Trump administration. I think that's a big win, not only for the US shale industry, but the environment as a whole.
And with that in mind, how are environmental regulations going to evolve? And do you see the industry doubling down on sort of, say, emissions reduction efforts? I'm thinking we ran a couple of roundtables in New York earlier this week. One of the key themes and takeaways from that was how much attention is the US or gas producers across the US going to put on cleaning up their operations, cleaning up scope 1, 2, 3 emissions to be able to sell into European markets, which obviously require low carbon gas as a fuel. How do you see that playing out?
Yeah, I mean, as you know, one of the biggest incremental sources of LNG purchasing is coming from Europe, trying to move away from the reliance on Russian gas. And it's very important to them what the environmental component of that gas looks like. I think net zero US natural gas is critical to that equation. My hope, our hope as a firm, I think for a lot of investors, is that companies don't move away from a lot of the pledges they've made on certifying clean, net zero natural gas, just because we've had an administrative change. I think most companies are supportive of some of the methane regulations that have been implemented under the current administration because it levels the playing field. And I think companies for too long have had to whipsaw their capital allocation strategy around the political environment. And I think the view is the future is net zero oil and gas supply. And there's a lot of different ways to get there, but that should still remain the priority.
Okay, no, that makes sense. And I think just looking at it from a macro level, as I say, we were in New York earlier this week running a couple of roundtables. We brought a number of LPs around the table, and maybe from these more generalist investors who aren't energy specialists, one of the bits of pushback that the industry's received from these groups has been around the fact that the industry is perhaps more technical than other industries, is perhaps more volatile than other industries, and that's deterred capital maybe from coming back into the industry at any meaningful scale over the past few years. Are there any macro factors that would cause actual or perceived energy volatility to fall in your eyes?
Yeah, no, it's a good question, and I do I do see that a lot of investors and allocators do get turned away by the underlying volatility, the technical aspects of the sector. I mean, if you kind of made a checklist of how do we resolve the underlying volatility issue, you would start with some degree of peace in the Middle East. I think the worst thing for this industry is having price volatility associated with geopolitical risk. It's unpredictable. It doesn't tend to filter through to the equities. So you tend to have movement in commodity prices that don't correspond to the underlying equities, because equities are going to discount the long-term price or the underlying futures curve rather than the changes in the spot price. I think the other thing that would really help is a more forward-looking OPEC pricing strategy. I think one of the concerns is that every 6 months there is this risk that OPEC's going to flood the market with new supply. And the fact that OPEC's been very reactionary rather than kind of forward-looking in how they're going to implement their pricing strategy and how they're going to resolve this issue of OPEC spare capacity, I think has been an overhang on the overall energy supply.
No, that's great, thank you. And I think if I bring it to Pragma and obviously what our purpose is and our mission statement, I think one of the reasons that we've wanted to come out and launch this platform is that the conversation has become very polarized in recent years. Obviously, we're headquartered in London. We see it worse than most, certainly over here, and I think the sentiment's very different when you come over the pond to what we experience back home. But the conversation has become polarized to no more fossil fuels, and there's been this maybe narrative that has existed over the past few years, particularly around the energy transition, where there's this belief that the world can just move off one form of energy and fossil fuel production and this energy mix, this energy system, which global economies have been built on and rely upon, and supply chains are built around, and just transition to other forms of energy and solar and wind. I mean, what do you think are the most dangerous misconceptions, or what is the most misleading narrative that exists today around the energy industry by the general public and by policymakers?
Yeah, I mean, I think one of the biggest issues is just people confusing the irrelevancy of energy in the financial markets as a sector compared to the irrelevance of energy in the global economy. And energy is the lifeblood of the global economy. And having consistent, predictable, affordable energy is key to any degree of economic growth, price stability, as we saw with inflationary pressures back in 2022. So I think that has been a learning experience for many that underappreciated the importance of energy in the global economy. And then I think it's just people take security of supply for granted. And I think that's really been a byproduct of the U.S. shale industry continuing to surprise to the upside in its ability to deliver oil production. But I think as an economy, as a sector, we really need to be scrutinizing the ability for U.S. production to remain consistent or predictable at these levels. Record U.S. production of 13 million barrels a day is going to be a challenge over the long term. And I think we've just become too complacent about that.
Okay, no, that makes sense. And I think continuing along that theme of pragmatism, changing that rhetoric, changing that narrative, what is the sentiment of the generalist investors today? We sort of touched on it at the beginning, but what's the sentiment today? And I guess, has the industry restored that faith of the generalist investor? And what more does it need to do to tell its story and actually say, these are the positive attributes that we bring to society, to growth, to economies? Sort of how can the industry tell that story better to get more shareholders on board?
Yeah, it's an important question. I mean, I've seen it firsthand, having worked at a large asset management firm around a number of generalist investors. I will say the kind of bias is to not own energy, if you kind of think about it as a starting point, because the things we talked about earlier, it's a very complex sector with this kind of geological underpinning, very volatile, unpredictable commodity price. Where you have generalists re-engaging in the sector is really this idea of when I don't own it and it hurts me. And that is about all upside price volatility. And that's generally why anybody owns anything that has a commodity-linked equity. It's participating in the upside volatility or protecting the portfolio from that upside volatility. Generally, rising commodity prices has an inverse correlation with almost anything else that's held within a portfolio. So unfortunately, relative returns do matter a lot, and you do see a lot of performance chasing. But I will say from a structural standpoint, I do think we're at the early innings of kind of reassessing the energy transition, the pace of that energy transition. 5-6 years ago, you had a lot of generalist portfolio managers that said, I never really need to own energy again because oil and gas are going away. And I think there is now a recognition on the durability of demand for oil and gas, that it does play such an integral role in the global economy, and that we've seen the negative implications of not having security of supply when you think back to 2022 and the energy crisis on the back of the Russian-Ukraine war. So I think there is an appreciation now that there wasn't 4 or 5 years ago on the duration of demand for oil and gas, on the longevity of the sector. But ultimately, we're going to need to see better relative performance before more investors are going to be interested in investing in the sector again.
No, that makes sense, and I think it probably answers my next question. But I think maybe flipping that on its head, what does the industry need to do now, as the Republican government, a Republican administration comes in, to make sure it doesn't overcorrect and revert to ways of old and prioritizing growth over capital discipline? I think that's a key sort of metric to show investors that they're serious about the progress that they've made to win back that confidence, to attract capital providers back to the space. What does the industry need to do to make sure it doesn't overcorrect and forget lessons learned over the past few years?
Yeah, no, I've always thought the sector needs to build credibility with its investor base, and that credibility comes from consistency of message, consistency of deliverability. The first test was when we had high oil prices. You go back to 2022, as we talked about, $100 oil, $6 natural gas. I thought the industry generally passed that test. We didn't see a significant impact on the rig count, on capital allocation, on the public equity side. But that was in the midst of an administration that was generally anti-oil and gas, had talked a lot about trying to shut down the industry from a long-term perspective. We now have an administration that's going to be very supportive of oil and gas and also rooting for growth in supply. To me, that's the second test. Are you willing to listen to your shareholders who almost resoundingly have delivered the message of we want capital discipline, we want capital returns over production growth? Or are you going to get seduced by whatever media or political message comes out around the importance of U.S. production growth? It's an important litmus test. I'd like to think ultimately companies understand the importance of listening to their owners, their shareholders. But that's an uncertainty that I think is weighing on the sector as well today.
No, that's really fascinating. And I saw the other week, and I'm reading here, in a recent New York Times article, you were quoted as saying, if you look at the relative shareholder returns, the market's been sending a very clear signal that it wants energy companies to focus on their core competencies. We've obviously seen headlines this year about majors, European majors, who have taken a very different strategy to their US peers in terms of pursuing the electron, reeling back on some of those commitments and doubling down on their core competencies and traditional oil and gas businesses. How has that signal changed over the past 4 years, and what are energy companies' core competencies that they should be focusing on to really create and deliver value for shareholders?
I think the fundamental challenge has been too many companies, particularly in Europe, listen to the loudest voice in the room, and the loudest voice in the room was telling them they needed to move away from oil and gas, and they needed to redefine what it meant to be an energy company. And I think not only was it premature from a timing perspective, but it forced them to step outside of their core competencies. And one of the analogs that resonates with me is this idea of, would you ask a pharmaceutical company to run hospitals just because they're in healthcare? Just because you're in the same sector doesn't mean that you need to be involved in every business within that sector. What oil and gas companies are very good at is extracting and processing molecules. And I think there's a lot of runway to do that, not only in traditional oil and gas, but in ancillary businesses that are tied to the transition, whether it's carbon capture, renewable fuels, something where you can actually demonstrate that you have a core competency and competitive advantage. But going out and building solar and wind just because your shareholders believe it's important from an environmental perspective doesn't resonate with shareholders that are focused on how do we have a profitable and sustainable business.
No, that makes perfect sense. And you also said in the article that doesn't mean, and you've alluded to it there, that doesn't mean abandoning the energy transition. It just means being more pragmatic about it. Definitely a statement that resonates with us. What does being more pragmatic entail, and what does that look like in your eyes?
Yeah, I think there's two steps to being pragmatic when it comes to the transition. Is one, accepting and acknowledging the uncertainty of the timing. I think too many people had false conviction around when oil and gas demand was going to peak. Like anything from a macro perspective, you want to have some degree of humility and say there's a lot of variables that are unpredictable, and we don't know the timing of that. The second is understanding the ramifications of a premature transition. I think for too long, the pendulum swung to one side and said, if we don't address climate change, this is the negative externalities associated with that. But I think we're starting to learn there's negative risks on the other side as well, which is not providing sustainable, affordable energy when the economy needs it has implications when you think about energy poverty, when you think about inflationary pressures that we're not prepared for. And so I think just being able to have that discussion, a more practical discussion around the cause and effect, the pros and cons of all these debates, I just think that's critical.
No, that makes a lot of sense. And I think one issue that I'm keen to pick your brains on and dig in a little bit deeper is there's been a lot of talk, and obviously it's one of the sort of 3 pillars of reform when you first laid out your strategy back in 2020 around prioritizing sort of capital discipline over growth at all costs. Obviously, there's been a lot of talk about resource scarcity, maturing fields, and obviously a lot of the top tier opportunities being sort of taken up by the larger organizations and the majors. How does the industry balance those opposing forces of maintaining capital discipline while also needing to go out and replenish future runways and obviously build out inventories for long into the future?
Yeah, that's a real challenge for the industry, and it's probably the number one issue that comes up when you talk to management teams and boards is kind of this directive of we want a sustainable business that generates a lot of free cash flow, but we don't want it to have this depletion issue of not having visibility into the long-term sustainability of the business. So I think it's a real challenge. I think the resource maturity of U.S. shale is probably underappreciated by the market. But that does not mean that companies have a directive to go out and add resources at any cost. And so I think managing that, the intersection of that is probably the fundamental or number one challenge for most public oil and gas companies. I think most of them have addressed it to date through consolidation. You've had some companies that have stepped out into new basins. You've had some that are willing to spend exploration dollars within existing basins, looking for second and third opportunities within existing or known resources. But where I come out on this is you need the right price signal, which is to invest ahead of that kind of appreciation that we need to move to higher cost resources is potentially an impediment to shareholder returns. So we want companies to have long-term sustainability. I think the easiest way to do that is to reduce production growth because by definition, that increases your resource life, your reserve life, and then ultimately wait for the right price signal to reinvest in future growth, whether that's production or resource growth.
And I think building on those comments, you alluded to it there, consolidation. It's been a crazy year, a crazy 18 months or so. Do you just want to summarize sort of what has happened over the past 18 months, sort of what brought that about in terms of relevancy in the public markets and so on and so forth? And where does that leave us today? Sort of just set the scene, then we'll delve into some of the analysis you did or Kimmeridge have done in its latest white paper. Sure,
yeah, it's an issue that's near and dear to my heart. We've been big proponents of consolidation. I think what you've seen is a greater appreciation for, in a mature resource like shale, the benefits of scale. And if you go back 10 years, when you think about the early days of the shale revolution, you actually wanted to be a small company because it was all about who could capture acreage, who could optimize it and sell on to a bigger company. And so smaller cap companies actually got a premium within financial markets. And that's evolved today where you now have record multiple discounts for smaller companies compared to large. That should always be a signal for consolidation, that larger companies now have a competitive advantage. with their currency or their equity to be able to consolidate. But it's not just about the operational scale. It is about investor relevancy. And the data would show you, when you look at shareholder data, that when investors, particularly generalist investors at large institutions, come back to the sector, they're gravitating to the names in the index that are generally large cap. And so our view has been a small company that doesn't have operational scale, doesn't have investor relevancy, is going to be challenged. That should be a catalyst for consolidation. It started to show up, as you know, starting in the fourth quarter of 2023 to today, we've seen a record wave of consolidation, and we don't think that's going to abate. We've been on record saying we think half the public companies in the U.S. shale industry probably need to go away, because there's just too much duplication of efforts when you have companies sitting across lease lines drilling against each other. There's too much opportunities for not only financial synergies, but operational synergies putting those companies together.
Yeah, that makes a lot of sense, and I think leads nicely into some of the questions around the latest white paper. Obviously, it's titled "Shale's Golden Years: Can Consolidation Keep the Industry Young?" Just to start off and dig into some of the work that you did there, you talk about how Kimmeridge have tracked the annual capital spending and reserves data of the public E&Ps for years. When you look at CapEx spending, production, what does the industry data show?
I think there's two clear conclusions coming out of analyzing that data. One, capital efficiency at an industry level is peaking or plateauing. I think the best years are behind us when you think about advancements in capital efficiency. I think that is a combination of geological maturity and the learning curve when you think about shale as a resource, the ability to improve completion design, to extend longer laterals. A lot of those things are now behind us. So you have a maturing resource. And at the same time, what the data shows you is there's a clear competitive advantage for larger companies. When we look at the cost structure of the largest companies of the industry, that gap has widened over the last couple of years versus smaller companies. Makes a lot of intuitive sense when you think about not only pricing power with the service industry, but the ability to drill longer laterals, have continuous acreage, all the things that we appreciate now with the economies of scale in shale.
No, that's brilliant. You also, delving deeper into that theme of efficiency and declining efficiency or reaching the end of maybe that peak. You also talk about the key metric you analyse from public E&P disclosures, and that being the recycle ratio, a measure of capital efficiency. Can you just explain exactly what the recycle ratio is? And you alluded to it there, but just double down on why does that matter so much?
Yeah, sure. I mean, to us, the recycle ratio is a measure of both capital efficiency and the sustainability of a business. And really what it looks at is the numerator is your cash flow margin. So how much cash flow you generate for every BOE of oil or gas that comes out of the ground. And the denominator is your F&D costs, and that really refers to finding and development costs. And that's how much does it cost, or how much capital is required to replace your reserves. And if you think about it, oil and gas is very different than most businesses because you have this depleting resource base. And so your need to constantly reinvest is critical. So you have a cash flow stream coming out, and you have a capital investment going in. And the ratio between those two numbers is ultimately profitability and sustainability of the business.
And I guess where are the easy wins? Obviously, a big theme has been around tier one inventory being swallowed up, being drilled up. Sort of obviously the cost of production is going up in the lower tier rock and the lower tier basins. I mean, where do companies go from here? Sort of, are there new basins that are attractive, that are that offer the opportunity for efficiency improvements, which maybe haven't been tapped up quite so much as the big basins like the Permian, obviously, which is the headline one. What are these opportunities, and what is it going to take to get investors comfortable going after some of these opportunities? Yeah,
it's a great question. I mean, we're seeing twofold strategy. One is companies going into underappreciated basins, some that have been less delineated or optimized. You've seen a number of public companies recently enter the Uinta Basin. That's one. We've seen some U.S. companies spending more time looking or going into Canada. There's a basin there called the Montney, which from a resource perspective could look very similar to something like the Marcellus here in the U.S., but has been less densely drilled, less optimized than we've seen in some of the U.S. basins. So there's probably a learning curve there that looks more like U.S. shale did 5-6 years ago. But overall, I think the biggest implication for the maturity of a lot of the larger basins in the US is just consolidation, because it allows you to drive that incremental efficiency. Part of it's high grading. So you put two companies together, you drill your best wells of the two combined. It tends to have a high grading effect on the overall efficiency, but also the ability to pull synergies out, pull cost savings out becomes more and more important as the resource is maturing.
I guess final question, can the industry take up more of the S&P 500, gain a higher percentage on the S&P? Can this consolidation lead to investors, I guess, reflecting or appreciating the value of the industry and having that knock-on effect, as you say, the rest of the economy, the industry is the lifeblood of the economy. Can that be appreciated in the public markets?
I think it will over time. I mean, I'd like to think that being sub 4% in the S&P 500 is closer to the bottom. And especially given in a historical context, that it does look like it's fairly close to the bottom. And so I think it's all about the duration of demand for oil and gas, which I think we're just starting to appreciate will be longer than most people expected. And then it's about consistency of deliverability on the operating side. And this is an industry that has struggled with that historically because strategies change, assets change all the time, and you have underlying commodity price volatility. But you're going to have to bribe investors to come back to the sector. And when I say bribe, I just mean overwhelm the free cash flow, the capital return. That's really where this industry has a competitive advantage. Their cash flow and return of capital can look better than every sector in the S&P. And so I think delivering that over time is going to attract investors. And I also finally think that most investors will appreciate that there is upside commodity price risk. That's been missing largely over the last 10 years. We've been in a deflationary environment because of the supply growth that we've seen in the US. And so having some change there, I think, will be critical to attracting investors back to the sector.
Look forward to following the progress and seeing where things land in the next 12, 24, 36 months. But last but not least, why have you decided to join the Pragma board?
Yeah, no, I mean, besides the fact that I have a lot of respect for you and Amy and everything that you guys did at the Energy Council, ultimately, I think energy illiteracy is probably at an all-time high right now. A lack of understanding, a lack of appreciation for the importance of the sector. Ultimately, to sustain economic growth, we need reinvestment into oil and gas. That's only going to happen with the proper advocacy and engagement on oil and gas to have political stability and capital flows into the sector. I think Pragma has a unique position in kind of initiating those conversations, connecting people, and having, it's in the name, a practical, pragmatic discussion about oil and gas, the role of energy in the economy, all the things that I feel really strongly about.
Brilliant. Well, delighted to have you on board and look forward to continuing the conversation. Thanks, Mark.
Thank you, man. Appreciate it.